Welcome to the Nadex Application and Strategy Webinar Series presented by Daryl Martin from apexinvesting.com. Today we're going to talk about futures gold contract specs, Nadex spread gold contract specs and basics, and Nadex binary gold contract specs and basics. Nadex gold spreads and Nadex gold binaries are derivatives of the CME's NYMEX gold futures contract symbol GC. A derivative is simply an instrument where the price is derived from something else, like a mortgage is a derivative of a house. And it's really helpful to understand the basics of the underlying instrument that the product is derived from when trading a derivative. So again, the product name is the NYMEX gold futures. And the contract size of the NYMEX gold futures is 100 troy ounces of gold. It's priced in dollars and dimes per troy ounce. For instance, the quote will be 1643.6. Notice there's not a penny on it, so it's dimes. And that is the quote of 1 troy ounce. So since the contract is for 100 troy ounces, the contract's actual value is $164,360, or 1643.6 times 100. A tick is the minimum fluctuation of a contract. Just like on a stock, a tick is a penny because it moves in a minimum increment of 1 cent. Well, the minimum increment for the gold futures contract is 0.1. And it's quoted in a single ounce. And the contract is worth 100 troy ounces. Therefore, a tick is worth $10, or 0.1 times 100. So every time it moves 0.1, that's a $10 change in value. If it's held past the last trading date and all the way to the delivery date, then the buyer of the future contract is expected to take delivery of the gold, and the seller is expected to deliver the gold. Again, the future symbol is GC, and the exchange it's traded on is the Chicago Mercantile Exchange, also known as the CME. And the CME is the owner of the New York Mercantile Exchange, known as the NYMEX. And the gold contract is traded on an open outcry on the NYMEX floor in New York. GC is traded electronically as well on the Globex. And here's the link if you want to go and look at more details on the gold futures contract. The Globex hours are Sunday through Friday, 6 p.m. to 5:15 p.m. Eastern Time. Now, there's a 45-minute break in trading each day, beginning at 5:15 and going to 6 o'clock. Now, also there's the open outcry, the pit market, where it's traded from 8:20 a.m. to 1:30 p.m. Eastern Time. And we'll talk about this in a little bit, but the Nadex spreads and binaries stop trading when the open outcry closes at 1:30 p.m. Eastern Time for gold. Future symbols have months that are associated with them. F for January, G for February, H for March, J for April, K for May, M for June, N for July, Q for August, U for September, V for October, X for November, and Z for December. Gold future contracts can be traded on any one of these months. To get the official symbol, you combine the symbol of the futures contract, GC, with the month, such as for April, you'd use J, and the year, such as 2013, you use 3. So GCJ3 would mean the gold futures contract that is due for delivery or receipt in April in 2013. So with all those contract months, which one is most heavily traded? Well, it's really simple. If you go to the CME's website, you can see the volume of the most liquid contract month. And you can see there's a substantial difference. 16,000 contracts currently be traded on the April gold futures contract. That's the one that most people are trading. Now, anytime you trade a futures instrument, you have to put up margin. Margin is the amount you have to deposit just to take a position on that contract. Per the CME, the initial margin to trade a gold futures contract is $6,600. And that's money held to open a new long or short position. Then maintenance margin of $6,000 is required to keep the position open. In addition, many brokers will offer day trading margins ranging anywhere from $1,000 to 25% of the initial margin, which is $1,650. And start times with various brokers actually may change. So some brokers may let you start as soon as gold reopens. Others may wait for the actual pit session or even the cash index futures markets to open before they give you the day trading margin break. Another really important thing to know about is called variation margin. And that's in addition to the above margin requirements, the contract is constantly marked to market. So profits are added into your account, and losses are immediately deducted from your account balance, and it's done live as the market fluctuates. And margin requirements may even change. The CME may say, hey, you have to put up more money instantly if the market spikes, like on a flash crash day or something like that, requiring more money to be put up immediately. Well, the combination of maintenance margin, leverage, and variation margin mark-to-market pricing can lead you to actually losing more than the amount of money that's in your account. The reason for this is you get access to massive leverage on margin. You're controlling $164,000 with only $1,000, giving you 164 to 1 leverage. And a margin call can occur when your balance drops below the margin requirement, and the position can be shut down, or if it's not shut down in time by the broker, they can demand the additional deposit be made by you, which could exceed the amount of money in your account. The CME Gold Futures contract is a derivative whose price is derived from gold. Nadex gold spreads are also a derivative, a price derived from something else. The price is derived from the CME GC Futures contract. The month's contract is derived from is listed in the contract's name in order to help avoid confusion, so that way you're following the right symbol. Inside the Nadex platform, you'll actually see the month next to the futures contract that you're trading, so you know to make sure to look at the right underlying futures contract chart, because you don't want to be looking at February or June whenever Nadex is following the April contract, because the price can and often does vary. Now, Nadex gold spreads allow you to trade gold with the contract that trades similar to the underlying, requires less money, gives you the ability to trade with limited defined risk, as your risk never increases as your margin is your maximum risk. And you have no fear of being stopped out by any kind of weird market spikes, because you have until expiration of the spread to be correct about price movement and direction. And you have no fear of a margin call, since your risk is capped, as all trades risk is fully collateralized, so you'll never receive a margin call and you'll never lose more than what's in your account. In addition, you have no fear of having to make or take delivery of a commodity. Nadex spreads tick in 0.1 like the underlying GC futures contract. Each tick on a Nadex spread is worth $1. No matter what the spread is, a tick is always worth $1, and this makes it a lot easier to trade futures on Nadex. Well, since the GC contract ticks in 0.1 with a tick value of $10 for the futures contract per tick, it takes 10 Nadex gold spreads to have a tick fluctuation in a gold spread to be the same value as a gold futures contract one tick movement. For instance, a 0.1 movement, 0.1 tick, is worth $10 per tick on a gold futures contract. Well, if you look at 10 Nadex gold spread contracts ticking in 0.1 on 10 contracts, would be $10 per tick. Okay, so now let's look at the risk and reward whenever you're buying a Nadex gold spread. Now, if you just hit buy and choose one, the Nadex platform will actually show you the risk and reward, but it's good to know what the formula is to calculate that. So if you went in and you were to buy it, then you take the bought price, so $16.52, and you'd minus that from the floor, $16.50. You'd then divide that by the tick size, which is 0.1, which will give you 2.0 would give you now 20 ticks. Every tick is worth $1 per tick, so $20 per contract. If you did one contract, you'd have a $20 risk on the trade. Since the risk is only $20, your margin is also only $20, and your risk will never increase beyond $20 no matter how far the market moves against you. And again, you have until expiration to close the trade. You can close it at any time, but you're not out of the trade. Your risk is simply capped. So now let's look at the profit potential on a bought Nadex gold spread. Well, if we bought it, then we subtract the ceiling from the price we bought. So if we bought it at $16.52 and the ceiling is $1,700, then it's $1,700 minus $16.52. The difference is 48.0. We divide it by the tick size, which is 0.1. You can know that just by looking at how it quotes. See how it quotes in point and then the decimal place right there. So one decimal place over, so 0.1. 48.0 divided by 0.1 equals 480 ticks times $1 per tick, $480 times one contract. So our profit potential on the trade is $480 profit potential, giving you a profit potential of $480 on only a $20 risk. And remember, you can close the spread at any time between opening and expiration. If you hold on it to expiration, it'll automatically settle in cash, and the difference between where you bought and the expiration settlement price will result in your net profit or loss. Okay, so now let's say that we think gold's going to go down. We could then sell, say, the lower spread. And we'd simply take the ceiling $16.50 minus the price we sold at, the bid price of $16.43. The difference is 7.0 divided by the tick size of 0.1, and that gives us 70 ticks of risk. Well, $1 per tick gives us a $70 risk per contract. So if we did just one contract, we have $70 in risk. And since the risk is 70, your margin is only 70, and the risk will never increase beyond 70, no matter how far the market moves against you. So the market could fly up all it wanted, but you'd never be down more than $70. And you have until expiration of that spread for it to come back and potentially be profitable on the trade. So now let's look at the profit potential in the spread. We'd simply take the price we sold at, $16.43, and we can make money all the way down to the floor, which is $1,600. And when we subtract those two, we get 43.0 divided by the tick size, 0.1, gives us 430 ticks times $1 per tick. So it's a $430 profit potential for one contract, and that gives us a profit potential of $430 on a $70 risk. And again, we can always close the spread whenever we want to. We can open it and close it multiple times before expiration if we want to. If we hold it to expiration, it'll automatically cash settle, and the difference between where you sold and the expiration settlement price will result in your net P&L if you don't close it before expiration. If you do close it before expiration, your net P&L will be the difference between where you sold and where you bought, but it will never exceed $430 based on this example for your profit. It'll never exceed $70 for your risk, no matter how far gold moves. The hours that the Nadex gold spreads trade and the number of contracts traded per hour and the width of those contracts is listed below. So as you can see, you can start trading 2-hour ones starting at 8, 9, 10, and 11 o'clock, and they'll be 15 points wide every time. And what they do is they set them 15 points above the market, 15 points below the market right before it starts trading, and they straddle it, so like 7.5 up, 7.5 down, and they'll have 3 strikes, just like we saw earlier, 3 different contracts. And then there'll be ones that have 6.5 hours till expiration, 3 of those, 40 points wide. There'll be ones that start as early as 6 o'clock at night and go to 1:30 the next day. Those are 50 points wide. And then there'll be the master spread, which is 100 points wide. Nadex binaries allow you to trade gold with a contract that can be used in both flat and volatile markets. They allow you to trade with less money than a gold futures contract, with limited risk, as your risk never increases as your margin is your maximum risk. And you have no fear of being stopped out by a market spike. You have until expiration of the binary to be correct about price movement and direction. In addition, you have no fear of a margin call, because your risk is capped, as all trades risk is fully collateralized, so you'll never receive a margin call, and therefore you'll never lose more than what is in your account. And you have no fear of having to make or take delivery of a commodity. Nadex binaries are basically a true or false statement. You're saying the statement is true if you buy, such as if you buy the gold April contract that says it will be greater than $16.55 at 1:30 p.m. Eastern Time. Now, if you sell, you're saying the statement is false. So you're saying the gold April contract will be less than or equal to $16.37 at 1:30 p.m. Eastern Time. Now, a very important tip is you may and should often close the Nadex binaries before expiration, so the statement does not have to be true or false at expiration to potentially profit on the trade. All Nadex binaries have a maximum value of $100 and a minimum value of 0. If the binary is held to expiration, it'll be worth either 0 or $100. It must be in the money at expiration to be profitable. In the money on a buy means the Nadex settlement price for the gold futures contract is greater than the strike at expiration. In the money on a sell means the Nadex settlement price for the gold futures contract is less than or equal to the strike at expiration. So if we bought the gold April futures contract is going to be greater than 1655 strike at 1:30 p.m., we're saying that statement is true. Well, the offer is $14, so the risk is $14. The profit potential, therefore, is $86. Since the maximum value is $100, simply subtract that from the offer quote, and you get the risk of $14. The margin to do this trade is, again, $14 on the trade. If we sold the gold April futures contract strike that says gold will be greater than 1637 at 1:30 p.m., we're saying the statement is false. We're saying it'll be less than or equal to 1637. The profit potential in this trade is actually the bid quote, $81. Well, the risk is $100 minus 81, so the risk is $19, and therefore the margin to do the trade is also $19. The Nadex gold binary strikes have multiple strikes and widths that you can take advantage of at multiple times. So there are the 2-hour intraday binaries that are 1.5 wide, and there's 9 strikes, and they start at 8, 9, 10, and 11. In addition, they have daily strikes where there's 23 strikes that are 3 points between each strike. They trade from 3 to 1:30 and from 6 to 1:30. And then there's the weekly strikes. There's 13 different strike prices that are 10 points wide, and they trade from Monday at 3 a.m. to 5 p.m., Monday to Thursday, 6 p.m. to 5 p.m., and Thursday to Friday, 6 p.m. to 1:30. Nadex gold spreads and binaries allow you to trade gold with less money, with limited risk. Your risk never increases as your margin is your maximum risk. There's no fear of being stopped out by a market spike as you have until expiration of the spread or binary to be correct about price movement and direction, and you have no fear of a margin call since your risk is capped. As all trades risk is fully collateralized, you will never have to receive a margin call and therefore will never lose more than what is in your account. And you have no fear of having to make or take delivery of a commodity. To open a live and or demo account, simply go to nadex.com today. Also visit us at apexinvesting.com to learn more about how to trade on Nadex.